All right. Really excited for my guest today on the Investor Podcast. We've got Benjamin Ehrlich. He's an LP. He founded First Momentum Capital. They're a fund of funds focused on investing in the best emerging VC funds and their breakout companies. I think that's really important, because you're essentially, creating a diversified vehicle that, asset allocators can, kind of get a mixed bucket of the best deals, and just kind of getting that diversified. Sometimes it's thematic, right? So there's some LPs that a lot of them that I've talked to, they really like concentrated managers, managers that are really focused, high conviction on a certain sector. Maybe they came from that sector. So, excited to nerd out on kind of how you think about this, Benjamin. But, number one, thank you for giving us your valuable time coming on the show. And, welcome to the show. So why don't we start, Benjamin, with you just kind of telling your origin story, just backing up to maybe your early childhood. Where did you grow up? What did your parents do for a living? Were you familiar with venture when you were a child? And, how did you learn about venture? How did you develop your skills? And how did you break into the industry? And then we're going to talk about firm building after that.
Yeah, absolutely. Absolutely. And thank you for having me on. I'm really honored. You have some pretty exceptional people on this. So I don't know really what you're doing interviewing me, but I guess we'll try and find out. So I, like everyone, I didn't know that I wanted to work in venture. I didn't know that I wanted to work in startups. It wasn't my dream as a little kid. I was going to be a hockey player. That didn't really work out. Then I was going to be a vet. And then I was like, oh, I'm allergic to half the animals. So neither of those career paths were really available to me. But I really credit this to, being able to go to the University of Michigan. So I grew up mostly, I'm originally Canadian, but I grew up mostly in Ann Arbor, Michigan. And I wasn't the best student, but when you go to Ann Arbor high schools, the chances of getting into the University of Michigan are much better. And so really kind of got this leg up where I was able to go to one of the top tier universities and surround myself with just truly exceptional and really driven people. And really, I credit this to a friend of mine where on like my second or third night at university, someone walked into my dorm and was like, hey, there's this entrepreneurship event happening. I don't want to go alone. Do you want to come with me? And I was like, I didn't even know what that meant at the time, but I was like, let's do it. Ended up going to this house and just like surrounded by just such exceptional energy. Right. And I was talking.
So was it like a frat house? It was like one of those like dorms. Because some people buy homes, right? And then they turn them into
it was called Shift. Yeah. Okay. And it was just like a house for people who wanted to build companies in Ann Arbor and at the university. And they would have these events where people would just come and talk. And like, you'd bring people from Detroit and people from all over Michigan would kind of come. And like, there was maybe 10 to 12 people who lived there. And I just it was just such an infectious energy. Right. And like, you'd go to the pre-med classes and you talk to people who want to be a doctor and they're like, I'm going to work, I'm just going to look at my textbook and study for 10 years. And then you talk to people going to investment banking and they're like, well, I have a 4.12 GPA, but I need a 4.13 to get to go to Goldman Sachs. I was like, but what are you going to do at Goldman Sachs? And they're like, well, I'm just going to make a bunch of money. And like, neither of those things appealed to me. But then when you go and you're surrounded by entrepreneurs and investors and you feel this like truly amazing energy, it's very inspiring. And then there was also this wedge, which I'm always very practical about myself, which is I knew I wasn't the smartest person in the room.
Yeah.
But I knew that I could work very hard and I was willing to try a bunch of different things.
Sure.
And it was the only community that I found where I was like, look, I don't know what I can do for you, but like, if you want me to help you write, taglines on a website, people would just let you do it. I'm like, this is amazing.
Sure.
This is a totally different community. And for someone like me, where I knew that I was going to work hard, I knew that I was going to push myself to the limit. It was a truly amazing community. So, got totally indoctrinated into the like startup, this was the early 2010s. So like startup, like move fast, break things. Facebook was like the hottest company. It's still one of the hottest companies.
So this was like a meetup, like the first kind of interaction was just kind of like a cocktail event with a bunch of entrepreneurs.
Exactly. And, I went to a bunch of these different things for a bunch of different career paths. I had no idea what I wanted to do. Like, I don't know any 18-year-old who really does. And this was the thing that kept coming back to me, and the people and the energy and my friends too, sort of just became this group of, people who wanted to work in startups or wanted to work in VC. And so right after college, ended up getting a job for a company called CribSpot. It was amazing. YC, I didn't even know what Y Combinator was at the time. YC backed company. I came in and they were like, hey, we need to figure out, we have no marketing. Do you want to do marketing for us? And I was like, I don't know what that means, but let me just call some reporters like at the local news and see if we can figure out to get a story, because that'll be marketing. So I ended up getting
essentially building your own PR practice, kind of, right?
Exactly. And I was like, I didn't even really know what PR, like I cannot undersell how little I knew about how any of this worked. I was like freshly graduated. I had a degree in economics and political science, but I barely, I kind of, wasn't the top of my class in either of those things. And so I just started calling people and saying, hey, do you want to come down? And ended up getting, someone from CNBC to drive down from Detroit and the Ann Arbor News, and ended up kind of becoming an integral part of this team. I then ended, that company ended up getting acquired, and I ended up going out to San Francisco and working for a bunch of different, basically trying to figure out what I wanted to do. I worked for a really, really great marketing agency called the Outcast Agency. Tremendous people, was not a fit for me because I don't listen to hierarchy very well. I was like, this is, there's like 20 people between me and the client. I don't really understand why that happens.
Yeah.
And eventually I'll kind of cut this boring part where I was lost and, doing soul searching and all those types of things where I was like, I don't know what I want to do, but I know I want to be around these people.
It's tough. I mean, I would say that time too, you don't, I think there's a couple things happening, right? You've got other friends that work at IBM or like Deloitte. They're making 200 grand a year. So you don't want to talk about being an entrepreneur around them because they just think you're someone that just doesn't know what he's doing in life. And then you're kind of hanging out with these entrepreneurs. You don't know if you want to be an entrepreneur. You don't even know what that means, right? So I totally get it. You're just trying to figure out, and what's helped me is just kind of figuring out what you're good at and what you enjoy doing, right? And that's kind of a start a little bit, right?
Exactly. My mom's a teacher, my dad's a doctor. They had no idea what this was. A lot of some of my friends were in investment banking and consulting, and like you said, making money and having nice lives, although they were working till 2 a.m. But eventually the thing that really, I would say, changed my life was a cold email, and kind of put me on the path that I'm on now, which was, I'd heard about this project called the Long-Term Stock Exchange, which was this, like, it was one of the first companies, and now I've met a lot, but it was one of the first companies where I read about it and I was like, this is a truly exceptional idea. And the idea was, it was very simple. It was that, wouldn't it be great if there was a different option for companies that wanted to be public in the United States, and to emphasize focusing on long-term growth backed by innovation. And you could do it in the public markets or the private markets. And I was like, that is one of the most exceptional things I've ever heard of. I want to go work with that. And so I sent a couple of cold emails and eventually ended up getting connected with the founder of Long-Term Stock Exchange, which is a guy named Ehrlich, who's famous in Silicon Valley for writing a book called The Lean Startup.
The Lean Startup, yeah.
And I'll never forget, I had sent a couple of cold emails and I had a couple of calls being like, who can get me into this? And then one day, I'd moved to New York at the time, but by this time I got a call from this number, and the call said, hey, this is, my name's Steve Goldstein. I saw your email. I work at Long-Term Stock Exchange. How fast can you be at this office in Midtown? Because Eric's going to be in town. I want to talk to you, and I think he'll want to talk to you.
Sure.
And I was like, excuse me, Eric Ries? You mean like the guy who wrote the link? He's like, yeah. You've been wanting to try and work with us. I've seen these like 10 emails from you. How fast can you be here? And I was like, I remember I looked at the train. I was like, it says 40 minutes on the A train. I'll be there in 39 minutes. Like something stupid like that.
Yeah. So they gave you a 1 hour lead time?
He said the phone call was literally, hey, this is Steve Goldstein. I work with Eric Ries at Long-Term Stock Exchange. Eric's coming to town today. Yeah. Here's an address. How fast can you be here?
Wow.
I was like, this has to be,
I'll be there in 30 minutes.
Yeah. I'll be there as fast,
You can track me in real time. Here's my, here's my,
exactly.
location.
I will run faster than the New York Marathon sprinters to get here. And so I ended up, going down there, having a long conversation with Steve, and then getting to meet Eric. I was super nervous, as anyone was. And we ended up hitting it off. And we talked about life. We talked about strategy. He was like, what do you want to do? I was like, I don't know what I want to do. I just want to have I just want to work on something really big. That was the thing that I kept on saying again and again and again. We had a couple conversations over the next couple of days and ended up, Eric coming back to me and saying, look, I don't know what I want. You don't know what you want to do. I don't know what I need. This seems like a great connection. Why don't we just work together for a couple months and then we'll figure it out.
Like if I can interrupt. So there was I forgot who was the guy that founded Gumroad.
What was his name?
Sahil.
He's amazing. Yeah.
So he had a post about like paid trials, and I thought that's brilliant. So like you bring somebody on, you give them a project, kind of like when you hire somebody on Upwork, but like that's a great way to hire somebody because you give them a few things to work instead of like, sending them an employment contract and then sending them like the whole, legal agreement. It's like, look, why don't we do a paid trial? Why don't we do 2 or 3 projects? I pay you, a couple $1,000, and that way, no harm, no foul. You got paid in consulting. You can build that as your portfolio. You can put that on your LinkedIn that you're, maybe you have an LLC that does some services, and we get to kind of test to see if it's a good fit, right? So is that kind of like maybe a loose kind of engagement model that kind of worked for Eric, or just kind of like, let's get to know each other?
Absolutely. And it's actually something that I've adopted over time, which is, and I realized that I was like, oh, I'm so special. Eric wants to work with me. And I realized, no, this is something he does, which is he says, hey, let's try something. Who would have thought the guy who wrote Lean Startup likes iteration and trying, it's crazy, but
so ironic.
But it is actually something that I've learned and just something I try and integrate, which is say, okay, well, we seem to like each other. There seems to be something here. Why don't we try this one very simple thing first? And be respectful and like, don't ask someone to work for free. I get paid. And when I work with fund managers now, I say, look, like, here's the things that I'm looking for. Here's my thesis around this. If you get to this point, then we should talk again. Right. But it creates a really fast feedback loop, and it allows you to build a relationship much more quickly, because instead of, to your point, coming in with an employment contract and this whole thing, it's like, no, you are there to execute on one thing. And you are there to build a relationship with one person. And if you succeed, then you can layer on all the other more complex things. And so, I think I succeed. That was 7 years ago, and we still work together to this day. So I think, we're still, I think I did pretty well on that first deal. And I'll never forget, again, you think about like the moments that change your life and set you on your path. I had gotten into a Columbia graduate program at the time, because what do you do when you're 24 and you don't know what to do with your life? Is you
go back to school.
Yeah. And
also when there's I think when times are tough, right? People go back and educate themselves. They get into the ecosystem. They try to and I think that's going to be very prominent as we look at the next couple of years with AI, right? There's going to be jobs that are going to go away that are never going to come back. If you're trying to study engineering, good luck, because a lot of the development work is going to be automated. So a lot of those people are going to have to reskill and probably go back to school, or maybe not go back to school, but get accelerated education for the skills that they need to get back into the workforce.
Yeah, right? I think we're sitting at a really, I'm very an optimistic person in general. And I think what you bring up a very good point, which is when you don't know it always in the moment, but you hit a lot of inflection points in your life, in your career. And I think like one of the most important skills that you can build, and this is something I believe in, and I talk to fund managers about it and founders about it, is like you want to be adaptable. Because when you hit these inflection points, you need to be able to change for where the inflection point is going. So I think like the people who are going to be really successful in this AI era are the people who are creative and flexible and can say, okay, I have this really strong foundation in software engineering, but Claude Code does my job better now.
Sure.
So how do I become a better manager of 13 different Claude Code agents versus just being a brute force engineer? And like that adaptability and that flexibility is going to become more and more important in a world where someone said this, so I can't remember who. It's like the era of declarative memory is over.
Sure.
Right. We don't have to know things off the top of our head anymore. It's gone. But we need to know, but the era of procedural memory, which is the part of our brain, which is, okay, if I do these 3 things, we can get to an answer. That's becoming very important.
Well, this is how I address it, right? A lot of people ask me, oh, is AI going to take impact VC? This is what it is, right? You're sitting in a boardroom and there's 5 people and you're about to close on a deal. They ask you a question. You're not going to have to state all of the terms of the term sheet, off the top of your head, right? But you're going to need to know kind of in general why this opportunity is a good opportunity. You're not going to be able to like pull up your laptop, search a prompt, and then turn the laptop around to recall that. You're going to have to still think quickly on your feet and be able to answer questions. It's okay if you don't know the answer, because you can say, hey, that's a good question. I don't know that. Let me get back to it. But a human still has to do that, right? You can't just completely talk to a robot there's still that relationship management that is still going to be prominent. There's still going to be negotiations, and then there's going to be just that quick thinking on your feet in a boardroom in real time. That it's just you can't replace that with anything yet. Talk to me in a year, maybe it'll be different.
Yeah, the scaling law is a little frightening, but I think you're right, and I think like being able to do like principled based thinking is much more important now.
Mm-hmm.
Right.
Sure.
Because and understanding incentives, right? Because like if you think about a negotiation, it's like, okay, well, I may not know the right structure. I may not know the exact word to put in this contract that we're talking about, but I know that from a first principle standpoint, we should be trying to optimize for X. And that's the type of work that's first of all, that's the type of work I love to do. And I think is more fun anyway. But I think that's the work that's going to be, going to become even more important in a post AI world where it's like, look, I can type into Claude and it can give me infinite variations of the same confidentiality clause in a contract.
Yeah.
Right.
No, absolutely.
So there's just no point anymore in figuring out which is the best. But the point is, okay, but what do we actually want the terms of this relationship to be? And how do we make sure that we're, as we continue to grow this thing, it's going to be really good. And again, like, I think that's for someone like me, who I think I value adaptability and I enjoy creative problem solving. Like, I'm excited.
Yeah.
But anyway, I'm going to fast forward through the next like 7 years to get to where.
So you went to business school, you did a couple projects for Ehrlich, right? And then tell me what happened after that.
Oh, and then I remember it was like my first day of class, and the day before my first day of class, Ehrlich called me and said, "Look, I think we're working really well together. What I still don't know exactly what it is that you don't have a job title, like you're just helping me do a bunch of stuff.
Sure.
Call it chief of staff. That sounds great."
Well, what were you doing for him? I guess, were you helping him with what were some of the things that, I guess, whatever you're allowed to share. I don't want to.
My first project was helping. They were in the middle of raising a Series B.
Okay.
And so my first project was, hey, build the slide deck for the Series B.
Great.
And I was like, I don't know anything about this company. And they were like, Eric was kind of like, well, what questions do you have? Because you got to figure it out because you're going to be building this slide deck. And so, we built that. We ended up having a pretty successful Series B, and then we B extension, both of which went quite well. And then so that was sort of the first project. And in that, I learned so much about the business and the storytelling business, right? Because there was 3 distinct business units, and there was a piece with the SEC that was going on. There was a software piece, and there was a consulting part of the business, and being able to kind of bring that all together and tell it in a cohesive story. And also just like work with a bunch of investors. Not, I wasn't the one pitching the company, but being on all these calls, hearing Ehrlich, who's one of the most visionary speakers. I mean, to this day, I'm still one of the most visionary speakers I've ever come across. You learn a ton of stuff. And so we had the successful Series B, and went sort of at the end of that fundraising period was also the end of my contract, and was also sort of the beginning of business school. So it was all these different
all the things, kind of the timing aligned to kind of have good continuity.
Exactly. Yeah. And so, I had this conversation with Eric the day before my first class, and he was like, look, I don't, come work for me. You'll spend some time, he's like, I've got some personal investing that maybe we can spend some time on. That'll become more important later. We've got some, LTSE's growing. We've got this fresh powder. We need to hire a bunch of people. Like, come help me build this thing. And I was like, okay, I need to think about this. And I'm someone around who makes these decisions. I agonize myself over these decisions. But this was actually the easiest one, because the next day I went and sat down in my first class at business school, and it was about technology, building a technology business was kind of the class. And the professor gets up there and he goes, hey guys, just, like a lot of other people have long course lists for this. There's only one book that you're going to need to read for this class.
Yeah. The Lean Startup, right?
Lean Startup by Eric Ries. And I remember, because it was like the most decisive I've ever been. I got up, I was in the back of the class, thankfully, got up, left, called Eric. I said, I'm in.
Yeah.
I didn't know, I didn't really, even at the time, there was no JD, there was no nothing. It was just like, this is the right thing to do. And that was 2019. So yeah, it's been 6-7 years. It's been an amazing journey since then. Sure. But sort of fast forwarding, because we launched into the first new stock exchange in 50 years, got the first new multiple listings since the creation of NASDAQ. It was a tremendous journey. I can tell you all about how hard it is to build a stock exchange and why it's a really bad business and why it's a really good business. But put that to the side, because I want to talk more about the fun stuff. Is that my job? It was an amazing job. It was about 85% LTSE, building the company, all that. But then there was this 15%, which was Eric was saying, okay, look, let's look at companies together. Let's look at startups together. Let's look at funds together. And just like, because I was interested in it. And he's like, great. Well, if you're interested in it, I don't have time to look at everything. Why don't we partner on this? It wasn't like a formal family office.
Yeah. But you're essentially almost like an associate for his private investing arm, essentially.
Exactly.
Right?
It was like, hey, I met this founder. You want to talk to him? Tell me what you think. It was great.
Well, if you think about it, right? I mean, there really isn't, even and we're going to talk about emerging managers, but a lot of these firms, they're figuring it out as they go. And that's, that's the main reason why I built this platform, years ago, just because I was still trying to figure out, I had insecurities. I was trying to figure out like if I was still sounding stupid or not, so what helped me was just kind of just doing it. And, I worked at a couple of firms and then just kind of surrounding myself with other people. And most of those people were not judgmental because they're probably secretly insecure and they're probably trying to figure it out themselves as well. So then after a while, you get this hive mind, right? Because a lot of people are just sharing what they've learned, what works, what doesn't work. So, loosely, you got to look at a company and just decide if it's a good investment, right? And there's the market, there's competitors, there's there's essentially the unique, selling proposition. But beyond that, you're still using your instincts to choose and decide to invest beyond that, right?
Yeah, and it's not a lot of data helps, but the data can be very misleading.
Yeah.
Right. And that was sort of the thing that I learned very quickly is that like all the things that you think matter, most of the time don't actually matter because some idiosyncratic event or some weird thing happens or the company pivots and turns into something amazing. And so like what really matters, like, I had this whole thesis when I was first building. I was like, okay, what's the market sizing? What's the TAM? What, how do you do this? And what I realized very quickly, as anyone who does any of this, is that it's really about, particularly at the early stage, it's about the people and the management team. And do you believe in them? And I mean, it was amazing. Like we had some early wins. We had some, companies that I was like, okay, we're going to invest in this Series B of this company doing 100 million in revenue. There's no way this company goes to zero. Literally next year it goes to zero. Had the opposite too, where it was like, I invested in this company 10 years ago. Who knows if it's going to be now it's one of these.
Well, this is the other thing too. So you're doing what you learned in business school. You learn like what you learn from all the blogs. You're like, I'm going to do top down analysis. I'm going to do bottom up analysis. And based on that, I think the market size is like 200 billion, right? But the founder saying it's a $2 trillion market. And then you talk to like 10 other VCs, they have their own calculations. So at the end of the day, like everyone is wrong until 10 years from now, right? Until you actually find out what happens, right?
Yeah. And what you want to do, and this was like a huge learning again from Eric, is like, you just say, what's my hypothesis around this?
Yeah.
Like, why could this work? What is my belief? And I do this with funds now too, where it's like, what are the factors of success that this person's going to have with their fund? Because it's different in each case, right? And because founders have different, I don't believe in like, there's only one type of founder that's going to be successful. I think history has shown there's no archetype for it. And so what you want to do is build a hypothesis around it so that you can understand where your thinking went wrong the last time. Because the only thing that you know for certain is that it's not going to work out the way you think it is. And, I've talked to a lot of fund managers now who are sort of on that first fund or pre-first fund. And they're like, I'm going to fundraise for 3 months. We're going to do our first close. We're going to invest in 6 companies. Then we're going to do our second close. So I'm just like, this is great. I'm going to screenshot this slide and I'm going to talk to you in 6 months. And it never works out that way. And I always say, it's not a big deal. Right? Like
sometimes it's good to be able to download the deck as well versus the DocSend, because you can actually see if the deck has changed. And you have that, that old deck on file, right, to see actually what happened. So
and it, I try and track all of those things as best I can. I take rigorous notes on everything that I can. But you never really know, and that it just anyway. The long story short is that the part of all of this stuff that I was doing with Eric, which led me to what I'm doing now with emerging VCs, is I just fell in love with that investing part.
Yeah.
I fell in love with it because you were helping people.
Sure.
Right. Eric wasn't the biggest check in a lot of these rounds or in these funds, but he was he was a huge name, and he could lend his credibility and lend his network. And so it felt like, hey, we're making a monetary commitment. Yes. But we're also making an energy, reputation, and sweat commitment to these founders and to these fund managers.
Sure.
And that was a part that I really loved. And so the first piece was just like, okay, I really, really enjoyed doing this. And the second piece was on the fund side, we caught some really good funds. Like we caught some funds that were giving DPI back in year 3 and are now sort of sitting at 7-8x overall, had caught some really, really great companies over this time period.
Yeah.
And even weathered the 2021 downturn with a lot of success. So, in sort of late 22, I was like, so I found something I really enjoy doing.
Yeah.
A clear path to making some money here. This feels like the perfect comp. This is the thing I've been looking for the past 10 years as I've been trying to, navigate what I'm doing with my life. Well, I found it. And so I went to Eric. This was probably summer of 22. And I was like, look, I have to have a really hard conversation with you. He was like, uh-oh. I was like, I'm going to quit and I'm going to go start. I found out that there's this structure called a fund of funds. Didn't know what it was until like a week before.
Sure.
I quit and I need to start this because this is what I love and I want to do it. And I had this whole speech prepared and I was ready to, have this whole argument with him. And he goes, great. Can I be your partner? Like, can I invest? When are we doing this? Like, let's get this thing up and running. And so that was really the genesis of First Momentum, was to say, okay, found what I love doing, found someone I enjoy working with, found something that I'm pretty good and can make money. And so we raised a small friends and family prototype fund 1, and I've been off the races ever since.
That's amazing. So let's talk about, and these are have you earmarked a portion to do some direct investing as well, or is that just kind of
we don't. We do that via SPV. This is a big learning. I've learned so much in this time period, but this is a huge one that my LPs have also pushed me on. Is that we're in the next fund we'll have some. In the first fund we didn't have any dedicated capital for directs. We just did it via SPVs. It's
also difficult with the fees and also just kind of how you're positioning your offering, because like what is the right percentage. You might as well just run, hopefully you get to the scale where you just do 2 funds in parallel, right? Because once you start thinking about like a closed-ended pool, you need to really think through how that is organized. And if it's kind of getting intermingled, it can get kind of messy sometimes, I'm assuming. So I think
and investment period, right? It's like, okay, so you're going to invest in funds over 3 years, and so then you need like 2 years for co-invest opportunities. So as the fund life very quickly turns to 25 years. And LPs don't always love that. Even if you're giving great returns. So there's also that like real dynamic of, okay, we're only going to invest in, our pool, let's say you do 15 managers. Well, you do 5 funds in the first year, you assume 20 companies a fund, like, and then 80% of those you're not even going to want to invest in anyway, and then you only get access to 5%.
Sure.
You want to balance these things.
Yeah.
And in the first fund that we raised, I didn't really have a track record. Eric had some angel investing, success.
Yeah.
We had done pretty well on the fund side, but it felt like let's do the thing that we think we're going to be really good at.
I just wanted to do a quick little demo. This is just a little fund model builder that I built. Cool. And I wanted to kind of do some brainstorming with you. So like when you're thinking about the reserve, let's talk through some of these. I think this would be a fun little, masterclass here. But like, obviously, probably, like a fund 1 is what, like around 7 to 8 years, ideally.
I think
and then probably, or you thinking, some of the funds I've seen, they've gone as little as like 3 years. So like, look, it's a prototype fund, right? So what would be a good period for like a prototype fund? I've mainly seen kind of like the smaller $5 million funds that are doing 3 years. They're like, look, we're going to deploy these many companies. Our assets are like, 5 million, 2%, 20. And then at that size, how much reserve should they think about? Like if it's high conviction.
Yeah. So you're assuming 3-year deployment period, 2 and 20 fee structure.
5 million. Right?
Yeah. So with the really small funds, it's interesting. Like there is in the LP world, it kind of feels like the early debates of the Catholic Church around 2 items, which is portfolio construction. How concentrated should you be? How diversified should you be? And the other point is reserves. And so what I always say is like my general baseline is that smaller funds should not reserve anything.
Sure. Okay, that makes sense.
Or should reserve basically nothing, because at the end of the day, the thing that will matter if you're raising a $5 or $7 million fund is the initial MOIC on a check is going to be the biggest returner.
Yeah.
Right? You're just not going to be able to play in a $30 million Series A. Like even your most impactful.
There just won't be enough capital, even if you had a winner, to double down on that, just because the AUM is so small. So
so do you like? It doesn't mean you don't follow on or put together an SPV or bring it to your LPs, but it's like when you look at sort of the actual numbers, and I built an ugly portfolio modeler that I'll kind of work through with people. Is like, say, like, if you're a $7 million fund, you have a chance to write another $250K check into a company versus putting $250K into a Series A that's valued at $100 million. There's no point in putting that $250K check is not going to be meaningful. Maybe it defends your ownership percentage a little bit, but not in a super impactful way.
Yeah.
That changes when you get to about 25, 30 million in fund size. You say, okay, now you've got a little bit more capital to play. Maybe that argument starts to change. But I think there's also like a broader argument here. And this goes into my also philosophy on picking fund managers, is the thing that made you a really good pre-seed and seed investor is not the same thing that will make you a good Series A investor.
Sure.
These are actually two very differentiated skill sets. It's a different type of underwriting. It's a different type of momentum play.
And sometimes there's a little more competition too with the Series A, right? I mean, there's maybe one or two co-leads in the Series A, so you're kind of competing a little more versus the seed. It's like, that deal still has probably a couple million left in the round, so there's plenty of room. And sometimes the investors are trying to help their founders close the round.
Exactly.
So I think that's, in my opinion, that's like the biggest differentiator.
I mean, you nailed it, right? Yeah. I think being a really good pre-seed and seed investor is about finding people before it's obvious and backing them.
And securing the allocation, if it's not oversubscribed.
Exactly. And Series A, it just changes. It's a different skill set. It's a different subset of things. It's not to say that I haven't seen people who are good at both. But again, that's why my baseline for the funds that we look at is say, look, don't either reserve a very, very small amount for opportunistic. If there's defend your position if there's a down round and you still believe in the company. But at the end of the day, we try and, I tend not to love reserves. Because again, like you want to maximize your shots on goal and maximize your ownership percentage relative to fund size. The best way to do that is to reduce your reserves.
Yeah, absolutely. So what advice would you have for maybe tech professionals, consultants that are thinking about their fund one? They want to go out and, or anybody in corporate America, they're like, look, and I've been, or just people that have been working for a big franchise for a decade. But like, look, I worked at Bessemer for almost 6 years now. And, I get my annual raise, I get some carry, which is kind of phantom carry. Right. But I think I want to build something on my own. I'm in my late 30s, early 40s. Now is the time for me to build. How do you think people should kind of think about that in their mind? And then let's talk about kind of like that minimum viable fund. What does that look like?
Yeah, well, I want to take that second piece first if I can, because I actually think there's been amazing work both done by Joel Yu. I mean, I want to give you some credit here, just helping GPs. There's a lot of other programs too, varying stages that they focus on. But there's been a Cambrian explosion of these programs to help people get off the ground.
Yeah,
and I think so. I think actually the MVP fund has actually come down to a very, very manageable size. I mean, I'm seeing, we invest in a fund that's 1.8 million, right? I mean, that's not a huge amount. And so I think
but it's easier to see DPI when the fund is so small, just proportionally, right? Because it's like a small little, markup that actually shows some real darts on the board versus obviously if you get a mega fund or if you're under fund 3, you're going to have to really amplify the returns to kind of show something.
I mean, so we closed at the end of 22. So our first close was the end of 22. So we're now 3 years in from our first close. That $1.8 million fund is the only one that's given meaningful DPI back.
Sure.
I mean, we've gotten bits and bobs here, but like that is what the situation is. And so I think I think this is really, really exciting, and why I'm happy to be talking with you and in your community is that I think this is actually a good thing. Because it gives people an opportunity to do the job, which is supporting amazing founders.
Yeah.
and gives people who are the best at supporting amazing founders the opportunity to do this work versus the people who are the best fundraisers, because sometimes those skill sets are the same, but not always. And so I think, like, when you're, my advice to people is always like, what do you think if in this, I'm actually going to credit Roy Bahat for this at Bloomberg Beta, because he gave me some early advice. He said, I always say to people, like, what's your snap your fingers amount of money that you have? Right. So tomorrow you send 5 texts and you have your fund size. What is that number? And be very, very real and critical with yourself about what that number is, and decide and start your fund process there.
Is that based on how much you could raise? Is that what you're saying? So like, if I probably push the envelope, I could probably hit these people up and get that? Or is that just kind of the capital that you think you can deploy?
No, it's capital you think you can raise in like a week and a half. It's kind of the way I think about it, where it's like, I know that these people have always wanted to support me. This guy will write a 100K check. This person will write a 500K check. I know without running any process apart from just hitting up a couple people, I can raise $2.5 million.
Sure.
Right. And starting with that and having a very honest discussion around that with yourself and saying, okay, because for some people that answers 10 million, and for some people that answers 500K.
Yeah.
Right. And so starting your fundraising journey and your portfolio construction journey and everything that's going to be downstream of that is say, what is the actual fund size where if I absolutely fail at everything else that I'm actually going to be able to raise and deploy? And
that makes sense.
Because at the end of the day, your fund size is your strategy.
Yep.
And what you're actually able to raise will determine what you're actually able to do. And so that's sort of the first conversation I have with people. I just talk them through and I say, okay, so if you think you can raise $10 million in a very short period of time, that's great. So maybe you want to end up at like a $25, $30 million fund. So let's map that out and let's map out the different situations and say, okay, what does your portfolio, downstream portfolio construction actually look like? If you think you can only raise 500K, well, guess what? You can still, AngelList makes it really easy. So you can still do a fund, but maybe it's like, okay, we're going to do this as a part-time thing. We're going to raise $1.5 million. We're going to do maybe a rolling fund structure, or maybe we're going to do via SPV or whatever it is. And we're going to actually have a different strategy and then go and raise that $10 to $20 million.
We've had people from, pretty big institutions, refer to the term synthetic fund. So like, you could cobble together those 10, 15 SPVs. Maybe that's like a couple million in assets. And, you can kind of hypothetically, you can work with your, if you do have a fund admin or, obviously like a CFO, you could actually put that together and actually thoughtfully showcase the performance off of those deals. It is not a single pooled structure, but just you can show the markups and kind of, represent what that could be if it was one pool of capital. But I've seen people do that, especially when you don't have that track record. You got to build it that way, right? So.
Exactly. And angel investing track record is a great tool. I actually wrote a piece with David Joe, who's amazing. You should have him on if you
David's awesome. Yeah. He's got some really good stuff. You guys have, that's what I was going to mention earlier. You guys have done some great content together. And I think that's a really great community building technique to just kind of, join forces with people. I mean, it's not really a competitive space. I think people are doing a lot of great stuff together. People are doing networking events together. So I think if you can kind of bring in good people together and do good stuff together, you're doing good by doing good, right?
Yeah, and I think it's always a balance, right, with these content pieces. And I actually am curious to see how you think about this, where it's like I want to be a really good actor in the LP space, right? I don't always, sometimes I'll miss emails. Sometimes people will drop off my CRM. It's not perfect, even though I like Affinity. It's not perfect. And so some of the work that we do, like with David, and David's much better at this than I am, is say, okay, let's think about things that are common questions that come up and actually make my life easier.
Yeah.
Right. Like, how can I make it so that when I meet a fund manager the first time, it's actually a much easier conversation, and it's a selfish thing that also benefits everybody else. Like, this is what I'm looking for. And so I've been trying to do a little bit more of this, and David's been a great ally in this. Say, okay, look, here are the things that I look for. Here's the process that I run. Here's the general way that I think. And it's actually turned out to be much more beneficial. I mean, I think one piece we put out, and I had like 95 inbound, or maybe it was 90, but not somewhere like 90, 95 inbound fund managers.
Yeah.
Just from that one piece. So again, it's a bit of a selfish decision to say, okay, this helps create deal flow and it helps me have better conversations. But hopefully it's also helpful to the community to say, okay, look, if you have an angel investing track record, here are the things that I'm going to look through, and here's what to do and what not to do. Right? Like it's hard. Like sometimes you'll see something where someone's like, look, I my angel investing track record is SpaceX.
Yeah.
And it's like, okay, but you invested in SpaceX 2 years ago, and you're saying you focus on pre-seed companies. So just help me understand that.
Mm-hmm.
Right. And so hopefully we can sort of shortcut those conversations.
Yeah. I think too, it's like, sometimes content is like, you should do this, or here's the top 5 things that you should do. I think if you just say, hey, here's what I did and here's what worked, people can't really get mad at you or criticize it that much because it's what you did. But if you try to prescribe something, sometimes like, hey, well, who the hell is this guy trying to tell me what to do? So what I've done is, like, a lot of times for me, I'm just like, look, here's a couple things that I've seen. Here's what I noticed that this person is doing. And then we have a content team they'll write a blog about it. And some people comment on it. Some people don't say anything, and that's good to know. But I think what's worked for me is just kind of, this podcast is live. It's live streaming. We're not going to professionally produce. Well, we will produce it later, but yeah, I think just getting it out is half of the battle, right? Just kind of like, literally, if you're thinking about something, hopefully it's thoughtful, there's some research around it, there's some reasoning behind it, and if you get it out, you actually got it out. Because there's some people that like do so much research and analysis, and they get like one post out every like 3 months or something, right? So I think you're doing the right thing, just kind of getting your thoughts out there, and then getting feedback from that.
Yeah, it's an interesting strategy,
mm-hmm.
and it leads to it has led to higher fidelity conversation, or higher quality, not fidelity, I don't know where that word came from, higher quality conversations, right? And that was sort of my hypothesis around this. Is I said, look, if I publish some content, the people who take the time to look at it and read it, hopefully those conversations will go better. And I think that is better. And to your point, like and David and I talk about this a lot. It's like, let's just write about what we think.
Yeah.
We're not telling anybody you have to do this, you have to do that. It's just, hey, this is what, when I look at an angel investing track record, here are the 3 things that I would look for. Doesn't mean that
I've also used it, I don't know if you've ever done this, but I've done this to just bookmark something. So like, for example, we put together, this is a deck template, like hypothetically, it's like a fund 2 template, right? But I just built it so that I have some template I can give people, and then I post it, so that way, if if I'm like kind of maybe putting together a deck, I'm like, hey, these are the things I need to think about. I can just refer back to that. So sometimes, and you guys probably do this too, you just create a resource so you can use it. It might be your actual IC checklist. And you're like, oh, where's that checklist? Oh yeah, I it's in our blog archive. So a lot of times, when I put together something, it's just because it's like something that I want to just bookmark for myself. It's like, oh, what are the 12 questions you should ask when you're doing an IC? Oh yeah, we actually wrote our own blog about it. So it's kind of a dual use where, like, it's your own kind of bookmark, but hopefully some other people get some value out of it. And if they don't, maybe they tell you a few things to improve. I've gotten that in the past, where somebody's like, hey, I got a suggestion. You should add these 3 more things. So I'm like, hey, that's a good idea. I'm adding it right now. It's really easy to fix. So.
Yeah, absolutely. And I think too, and this is why I also love the fund to funds approach, is that the data in this market in particular is so hard to come by and so low quality.
Sure.
Right? Is that like, it's just very hard to find actually interesting, good content about what's going on, both at the allocation decision level, but also to the innovation level.
Yeah.
Right. So I think putting content out about how you think is helpful for everybody, and hopefully it encourages others to do so. And like, one of my favorite things is reading when I can get a portfolio company update from a fund manager. Right? Like when I can get the actual update from the portfolio company, because we pick our managers because they're better at finding founders and better at specializing in certain areas than I am. And so they're finding really sharp and smart people. And when I get to read what those our managers, I think, are smart too. But when I get to read the updates from the portfolio company level and sort of see what's going on there, that's the absolute best.
Yeah.
Right. As you just learn so much and you get so much insight into what's actually happening on the ground. And I think, when we were starting this, a couple of my LPs were sort of asking me, they were like, look, we like you. We want to back you. We'll do this weird thing. But like, why do you want to be an LP? Like, you don't actually get to see anything. I'm like, but at the end of the day, you get to see way more.
You do. Yeah.
Because,
we hosted this, every quarter we do this thing called the Allocator Summit. And this one was really crazy because we had a couple managers present. One of them was a fund to fund, So the fund of fund talked about one of their funds, and then we had one of their funds portfolio companies present as well. So we had the full stack. We had the LP, how they think, a couple managers, what they're thinking, but then we actually had a founder speak as well. So if you really think about it, you're at the top of the food chain because you're kind of at the fund level. You have peers that are LPs, and then it's very easy to go top down. I think sometimes it's tough to be in the rooms when you're the founder, right? It's tough to actually, you'll never get into a room with the LPs, but let alone get into the room with the VCs. So I think it is a really good position to be because it's very simple to kind of get that look through down, because a lot of the managers are going to be talking about their portfolio company updates, and they want to make sure they're really good updates because they're coaching their founders to do a good job too. So I think, to your point, I think you really get the best look through possible from the level that you're in.
Yeah, absolutely. And I think for our LPs, they love that look through as well. Right. So we had our AGM a couple of weeks ago, so end of October, and I brought a couple founders. Well, I brought one founder and I wanted to bring another, and then they got sick. But we opened up the whole thing with a discussion with one of the founders in the portfolio level, and people said that was their favorite part, because again, when you actually talk to people who are doing the work on the ground, you learn the most and you get the most sort of high quality data. And as an LP, that also helps you choose, when you're looking at other GPs, you're like, well, I know that the founders were talking about this, and you're talking as a GP, you're talking about something completely different. So then you get to kind of bridge that gap and do that work that is pretty fun. It's putting together pieces.
Yeah, totally agree. Well, hey, we got 2 minutes left. I always end every podcast with just a piece of advice, could be from Eric Ries. I mean, look, you've already given me a lot of wisdom about him, but maybe it's a mentor, maybe it's a friend, maybe it's just yourself looking back from this year, but, just give us a piece of learning or advice that we should take with us. And you're like me, you've kind of had different, career paths, and you kind of found yourself going through those different career paths and taking you to where you are now.
Yeah. Oh man, piece of advice.
Could be from a relative. It could be from, a mentor.
I would just say, the one thing that I always try and remember is that nothing is inevitable.
Yeah.
Just really
in a good way or a bad way.
Yeah, exactly. People, all the AI doomers, all the AI optimists, there's we get to choose. And so you get to choose and so I tell myself that every single time where I'm the anxiety is rising, you're looking at something like, wow, this is just this is going to go so badly. There's nothing in the world that is inevitable. I think that's what makes allocating and investing so fun, is that you get to make a hypothesis about the world and then see if you were right.
I totally agree. Well, Ben, this was amazing. Hopefully I see you this Thursday. We get to hang out.
Absolutely. Joel. Thanks for having me.
Yeah, really appreciate it. And we'll catch up soon. Thank you so much.
Absolutely. Thanks.
All right. Take care. Bye.